As we look towards 2026, the global economy is evolving in ways that could reshape opportunities across emerging markets. So how will technology, shifting policy, and economic cycles interact to create new growth opportunities? Which markets are better positioned to navigate challenges, and what lessons have they learned from the past? We're going to get into all of that and a lot more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for being here with me. Alejo Trawanko is back in the studio with me. Of course, he is the Chief Investment Officer for Emerging Markets here at UBS. Alejo, good to have you back.
Thank you for having me.
As we're talking about ending the year, we're already looking towards 2026, and there's some compelling implications for emerging markets when we're looking at that year ahead. So I thought we could start by kind of talking about the global backdrop. What do you see for 2026 in an environment where can emerging markets thrive? What does that environment actually look like?
As you know, Anthony, in investments as in life, it's better to be lucky than good sometimes. And I think emerging markets are being lucky from the perspective that all those things that are beyond their control, they're going fairly well. Financial conditions globally are easing. The Fed is cutting interest rates. The dollar is softening. This allows emerging market countries and companies to borrow cheaper than they would otherwise. And in addition, looking into 2026, not only do we think that financial conditions will remain easy, commodity prices, we're penciling in an appreciation of gold, of other commodities like oil, copper, lithium. And so this is something that lifts terms of trade for developing economies. That is, the price of what they sell to the world goes up relative to the price of what they buy from the world. So the external backdrop is pretty good going into next year. Emerging markets are fairly lucky from that perspective.
Right. So, of course, luck is one part of the equation, right? But then you have to also take into account real skill and know-how and expertise from someone like yourself. So here's the question. Will the emerging markets have an opportunity to take advantage of those fundamentals that you're talking about?
That's right. If you think about next year, we do believe skill will meet luck in a way, because the economic backdrop within emerging markets is quite good. Growth is resilient. China growing at 4.5% into 2026. India, 6.5%. Mexico accelerating vis-a-vis this year. So we're seeing resilient economic activity in the face of multiple shocks. Inflation moderating across the emerging markets, which allows central banks to cut interest rates and accompany financial conditions in the developing world. All in, I think the macroeconomic house of emerging market is fairly in order. Let me give you a couple of illustrations of this. We are witnessing more ratings upgrades of countries in the emerging markets than downgrades at a rate we haven't seen in 5 years. When it comes to companies, default rates are less than 2%. Compare that to a 10-year average of over 3.5%. So by and large, I think they're taking advantage of their luck through a good amount of skill.
I mean, is that, so what do you attribute that to then? If you're looking at 5 years, is it better domestic policies on the ground in these countries? Is it, the movements of global central banks? How do you attribute that most of these countries are getting upgraded rather than downgraded?
It's funny, Anthony, we talked about this in past episodes of the Trending show. It is unclear these days what is an emerging market and what is a developed
market. The line is blurring now,
exactly.
Isn't it, between developed and EM?
Exactly. When you look at the quality of policy making, when you look at how seriously they take their institutional setup, the overall macroeconomic health of different countries, it is unclear. What are you referring to, an emerging market or a developed country? One concrete example, I asked ChatGPT the other day, which country is more fiscally responsible, Peru or France? the chatbot was very, very clear. Peru is a lot more responsible, right?
Interesting.
That you wouldn't have expected that answer
No.
years ago. And I think the answer has merit. Lower debt to GDP, lower deficit to GDP, an independent, responsible central bank, right? Consistent growth. There's challenges all over the world.
Yeah.
My point here is the lines are blurring.
Yeah.
Your portfolio needs to reflect a new reality in which there's convergence across geographies. So you do need to take advantage of geographic diversification.
Yeah, and you also wrote recently that sovereign credit rating upgrades make up 62% of all ratings. So
Yes.
you can flow it through from equities to fixed income, and you're seeing that there's these more stable macroeconomic and financial conditions in a lot of these countries. It's a really, really interesting time for EM.
Yes, historically you'd expect EM equals volatility and crisis.
That's right.
Right, things are changing. There's still volatile EMs. The depth of capital markets is a concern. But from a macroeconomic standpoint, many of them are better managed than the developed market counterparts.
We might have to start calling it EM 2.0.
Exactly.
It's not the
yes.
EM from 5-10 years ago.
The terms are evolving.
Right.
Maybe developed markets might be submerging markets and vice versa.
So the next question, almost, it seems like there's a basket of opportunity, because it's always like, where are the investment opportunities today within the EM space, or whatever we're going to call it in the future? Where do you see the best opportunities right now for investors, and especially as we look towards next year?
Starting with equities, we rate emerging market equities as attractive in our global strategy. This means we expect solid total returns in 2026, driven by earnings growth. This year, emerging market equities earnings growth 10%. Next year, we think it's going to be 15%. Why is this? A combination of AI and commodities. Today, 50% of the emerging market equity universe is technology linked. The remainder, good exposure to commodities. We think both will traction and help total returns. In this context, we like China technology, earnings growth expectations 35% for next year, one of the highest anywhere in the world.
Incredible.
We like Brazil because of the cutting cycle there, because of the commodity exposure. We like India, resilient market with solid earnings growth potential moving ahead. That's equities. In fixed income, we think you can use emerging markets to improve overall portfolio yield. Yield levels are pretty good, 7%-ish in US dollars. Now, spread levels are tight, like almost anywhere else.
Yes.
Exactly. So approach the asset class with caution, like you would any credit product, but take advantage of the yield levels. So those are some of the ideas that
Excellent. And just as we wrap up, nothing comes without risks, even though we're talking about really favorable conditions for EM in 2026. What would you say are the potential risks right now?
Yes, I'd say if our baseline of a cutting Fed and a softer dollar doesn't materialize, that is a problem for emerging markets. Imagine for a minute a hiking Fed and a stronger dollar. That would really affect the overall narrative and story for the developing world. That's one thing. Geoeconomics, geopolitics. We live in a new world of fragmentation, multipolarity. The next shock can come from unexpected places. And if it hits emerging markets directly, that is a problem. Finally, I would highlight indebtedness. Indebtedness is high everywhere, particularly developed markets, but there's almost nowhere to hide. And so if we see a spike in concerns about debt sustainability in the US, Japan, the UK, China, we might have a scare.
Excellent. Alejo, thank you. I've really enjoyed all of our conversations throughout the year. I'm looking forward to 2026, and it seems like there's a lot of exciting things happening in the EM space. So thanks for coming by.
Thank you for having me.
Have a great Thanksgiving, holiday season. See you soon.
Same to you.
Thanks, Alejo. And thank you all for joining us. Lots more information from Alejo and the team available at our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, you can check out our Instagram page at UBS Trending. Lots of great content there for you. And as always, we encourage you, if you do have any questions or would like to continue this conversation, make sure you're doing so with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.